and volatility of recent FOMC and CPI days. We're going to take a good hard look at what we saw yesterday, and CPI is CPI tomorrow in addition to everything else?
Now you're really making me test here.
Because I got so messed up with the earnings today. Is CPI tomorrow too?
February 14th is what I got for CPI.
Oh, okay. Then it's not tomorrow. Then it's February 14th. Good. Okay, let's go. Good.
I think. I mean, listen, you're making me look real quick.
I don't need a CPI number tomorrow. Market implied volatility, the VIX, closed at 1787 on February 1st. That's yesterday, 2023. It was the lowest VIX close since January 12th of 2022. With roughly 30% of implied volatility was taken out since mid-December and 50% since mid-October. We wanted to study the change in intraday volatility on the recent FOMC and CPI days compared to the releases at the end of 2022. Let's go to the next slide. So we did a study. We looked at the SPY and the Qs, and we looked at the intraday price data in January of 2023. We added the intraday price action on the previous two FOMC and previous two CPI report days. We computed the annualized realized volatility. I'm not sure if that's proper, but annualized realized volatility. The annualized realized volatility based on 5-minute intraday price data on the recent CPI and FOMC days, and compared it to the intraday volatility to an average day in January. I think Anton had too much time on his hands yesterday. So let me see this again. Hold on. We computed go back one slide. We computed the annualized realized volatility. That's what actually happened, based on 5-minute intraday price data on the recent CPI and FOMC days, and compared it to the same intraday volatility to an average day in January. Okay.
And tomorrow is the jobs report, unemployment report for unemployment situation for January.
Got it. So comparing the intraday volatilities will show two things. First, how much more volatile the event days were than the average market day. And second, how much more volatile the FOMC and CPI days were at the end of 2022 compared to the most recent ones. Okay, I'm curious about this.
I am too.
Here we go. So the most recent FOMC and CPI releases in green below show a 25% reduction in intraday volatility for both the SPY and the Qs compared to the report days at the end of 2022. So what we did here is, let me just try to clean this up a little bit because there's so much stuff on here.
A lot on the screen, sure.
Yeah. So HV is historical volatility. That's what actually happened. So the SPY and the Qs for both of these reporting days versus all days intraday price action. So the first one is the average day. The second one is the FOMC in February versus December, and the second one, and then the third one is the CPI which was January of this year versus December of last month. And what you can see in all these cases is a huge, well, they put it up here. It's a 25% reduction in intraday implied volatility. Tony, let's see for a second. Average day, all the time, and then FOMC, and then FOMC a little bit ago. So what we're seeing here is a huge decline in implied volatility over the last couple of months, and even more so, even a greater percentage decline from just these kind of events, right? I mean, that's really all this is. I'm not sure what the read is from this.
Yeah.
But let's go to the next slide. So the most recent FOMC and CPI days in green were still roughly 25% more volatile than an average day in orange. So I think that's the takeaway. So even though there's been a huge reduction in the amount of movement that we've seen since last year when volatility was higher, you still get a massive amount of contraction. Well, a massive amount of, because this is yesterday. So you still have a massive amount of expansion relative to an average day. So it's 25% less volatile than it was going back to December, and 25% more volatile than an average day.
Okay. I mean, it's playing with a lot of numbers.
I don't think that would surprise any of us.
No.
I don't think that would surprise any of us. Let's put it that way. Okay.
Right.
Let's go next slide. So with the recent drop in market implied volatility, we also saw a decline in intraday volatility of the binary event days. So the takeaway there is when the market volatility contracts, so does the event day volatility. So lower market volatility, lower event day volatility. The most recent CPI and FOMC days saw 25% lower intraday volatility compared with late 2022, but we're still 25% more volatile than an average day in January. Notice the VIX declined by nearly the same rate from mid-December as the intraday volatility did on event days. So we tested here was we looked at something that we don't usually use for data. We looked at 5-minute data, and we looked at the 5-minute data because we wanted to see, hey, if volatility goes down, does the corresponding volatility also go down for event-based days, like yesterday and like today, or whatever the next CPI number is? And the answer is yeah, we're 25% less volatile than we were last year, but we're still 25% more volatile than we are on an average day. And that's the takeaway.
Very good, sir. Hey, let's take a quick 90-second break. We'll come back. Market caught a little bit of a bid here, sounding up. Even the S&P is up 37. NASDAQ back up over 300. Russell up 20. Dow down by 180. Volatility down 24 cents. We'll take a quick 90-second break and come back. We got more Tasty Live coming up after this with, oh joy, Mr. Scott Sheridan next. Tastyworks World Headquarters.